Well, greetings, my beloved clients and friends. Today is October 8th, and interest rates have gone up a lot lately. And I want to talk about the threat of 5% interest rates. Okay, so Powell controls the overnight rate, and he's raised it, I believe, 10 times, and it's at they quote it in a range. It's been between 5.25 and 5.5, up from 0, right? And he pushed up the short end of the curve, but the long end of the curve didn't go up as much. But recently it has. At the end of the first quarter, end of March, the 10-year Treasury was about 3.25. And in the last 6 months, it's gone up 1.5%. So now it's about 4.75. And so it has kind of followed with a lag the direction that Powell wants it to go. And as it gets higher, it will slow down the economy. And that's what he wants, because he sees inflation as a huge problem, and he's trying to slow down the economy, slow down spending, so that less money is chasing goods, and that's what's causing prices to go up, because a lot of money is chasing goods. So he's trying to keep money to not move so much, to not chase goods so much. And one way to do that is to raise rates, because when you raise rates, money costs more, right? If you're gonna borrow to buy a house or a car or whatever, higher rates means the effective cost is higher. And the other way is that encourages money to sit still. If money could do nothing and earn 4 or 5%, then people will be more likely to just leave their money alone. And I'll tell you a story that I've said before, but one time I was out golfing after work. I tried to get in 9 holes, and so I went to the golf course, and I was a single, right? And the guy says, "Hey, there's another single here. You want me to match you up?" I go, "Yeah, sure." And it was an older guy. This was a long time ago. I was a young kid, and so he matched me up with this guy, and we're playing, we're chatting, and he's like, "So what do you do?" I said, "I'm a financial advisor." And immediately his defenses went up. He's like, "Great, this guy's gonna try to sell me something," right? Because he knows what that means. A financial advisor means you sell investments, right? And so he threw out his defense right away, right? He said, "I have all my money in 8% muni bonds. I'm not moving it." I didn't even ask him, but that was his immediate response. So basically he says, "You know what? I have my money parked. It's making me a good risk-free rate, and I'm not looking at taking any risk. I'm not interested in moving it out of there," right? Because he had found a good place to park it. Perhaps in the past, he was a capital allocator. Perhaps he was an investor, a risk taker, right? That he would take money and he'd put it to work in some stock or some real estate project or some business, right? And buy equipment or invest and try to get a return, right? But he got to a point where he saw an opportunity that without taking risk, without putting it to work, he could get 8% just sitting there, and he could play golf and not have to worry about it, and not have to run a business or worry about the ups and downs of anything. He'd just collect his dividend, right? So that yield of 8% had enticed him to get out of the game and just sit on the sidelines and earn his 8%. And as interest rates go up, they entice more people to sit on the sidelines. As interest rates go down, it makes people on the sidelines antsy or impatient or wanting to do something, right? If your money's in the bank sitting there making 0%, are you totally thrilled that, hey, my money's sitting there making 0%? I'm not interested in anything else. Of course not. If it's making 0%, you're interested in something else, right? Let's look at real estate. Let's look at stocks. Let's look at starting a business, right? And I'm not talking about the average Joe. I'm talking about big capital allocators, the allocators that are allocating hundreds of millions and billions of dollars. They're not content when the money's sitting there making zero. And that was the case for the last decade. So they put it to work. They put it to work in risk capital and investments in the stock market and real estate. And all those things did well, right? Because money was flowing to them, because money did not want to be sitting still at 0%. And that's what the Fed does. If they want money to move, they want money to go into investments, to real estate, to the stock market, to business opportunities, right? They'll lower rates, and it'll make that money uncomfortable at that low rate, and seek out higher returning opportunities, risky opportunities, if you will. And so once he started raising rates, he said 1%. I'm going to raise it from 0 to 1. Money's not going to go to the sidelines for 1%. So he said, I'm going to raise it to 2. And you know, if the stock market is yielding, the yield on the S&P 500 is about 1.9. You know, money could say, well, I could get a 1.9% dividend in the stock market plus upside. I'm not going to park it at 2%. So he raises it up to 3. And at 3, which it hadn't been at in a long time, is some money going to say, okay, maybe for 3 I'll go to the sidelines. Maybe a little bit, but not really. And then, like I said, in April it was at 3.25, right? And in the last 6 months it's gone up to, I'm talking about the 10-year Treasury, it's gone up to 4.75. Then it crossed that 4% threshold, a threshold that it hadn't been at in a long time. And at 4%, like around the beginning of August, I think it entice some money to go to the sidelines. I'll take 4% and not risk, because you know, you look out on the investment horizon, you say, well, you know, the country's in a lot of debt. You know, there's geopolitical uncertainty. There's an election coming up. Maybe I'll go to the sidelines and sit on 4% money. So as the rates get higher, it starts enticing more money to go to the sidelines, to not go into the stock market, to not go into, you know, real estate market, to not go into starting businesses and expanding businesses and investing in capital, because you go on the sidelines at 4, right? And I think, you know, money's starting to slow down because of that. It's kind of like that show, Who Wants to Be a Millionaire? And I don't know if you've seen it, but there's all these briefcases, and they have a number in them, and that represents the money, and it goes up to $1 million, and it starts like at 1. And I haven't watched it really closely, but I think you try to pick briefcases till you get down to the last one, and whatever in the last one, that's what you get, right? And so people are playing like, open that one, and I hope it's a low number, you know, and you're trying to eliminate those, and as you progress along, if it seems like it's a chance that this person might win the $1 million or even the $500,000, there's this silhouetted manager who is not wanting to give away too much money, right? And they'll entice you. They'll say, well, I'll offer you $50,000 to quit playing the game. And the player is like, well, I can get a guaranteed 50,000, or I have a chance at that $1 million. Forget it, I'm gonna take a chance, right? And that's the exciting thing about the game is this person gonna take a chance, or are they gonna walk away with the secure money? And as that silhouetted manager, they'll raise the stakes. What if I offer you 100,000? What if I offer you 200,000? And then that's person saying, I could walk away with 200, or I could take a chance. At a certain point, they're going to say, I'm going to walk away and stop playing the game, right? When that opportunity sounds pretty good, the guaranteed opportunity, although it's not as big as the risky opportunity, it's big enough, And that's kind of what Powell's doing. He's like, can I entice capital with a 4% rate? Or how about a 5%? To sit on the sidelines and stop playing the game. And so when I said the threat of 5%, because I think it's getting pretty high to the point where, at a certain point, risk capital is going to take that safer off ramp, that safer offering, and just say, okay, I'm out of risk capital, which I'm talking about the stock market. I'm talking about business in general, which is the state of the economy, the capital allocators that are hiring people and that are, putting money towards projects that gives people jobs and that creates the economy to move, right? And that's why I called it the threat of 5%, because as we're getting over 4.25, more money starts going to the sidelines, because they'll say, okay, at 4.25, I'm out. 4.5, 4.75, and that psychological next number from 4.95 to 5, it's not any different than 4.9 to 4.95, but psychologically it is. To say, I went to the sidelines at 5 sounds better. Like the guy I played golf with. If he would have told me, oh yeah, my money's sitting at 7.95% and I'm out of the game. It sounds better for him to say, my money's at 8%, and it feels better. And so I think there's a real threat that if rates get to 5%, that a lot of money can all of a sudden go to the sidelines. And if it's not 5, then we're starting to get close. We're not that far away. Maybe it's 6. For sure it's 6. Maybe it's 5.5. I mean, if the 10-year got to 6% and the offer was on the table that you could be out of risk capital and just sit on the sidelines making 6 risk-free, how much money would it accept that offer? I think a lot. And I think it would slow down the economy very quickly, right? Because here's the other thing about, let's say you go to the sidelines at 5%. So that means you put your money in a 5% treasury bill for 10 years. And sure enough, the economy slows down. They have to raise rates again. And let's say a year or two from now, the 10-year is back down to 4%. But you locked in at 5. So you have this 5% bond that still has 8 years to go on it, and it's going to continue to pay 5% for those next 8 years. And at that time in the market, the only thing available for a long-term investor that wants something safe is 4%. So let's say you decided to sell your 5% bond. Do you think you could find any takers? Absolutely. Because they're like, all I could get is 4, and this guy showed up offering 5, right? Someone would say, I'll pay you a premium for that one. Okay, because money used, or bonds, a used one is just as good as a new one, right? If you had a 2023 $100 bill, it's just as good as a 2018 $100 bill, right? So yeah, that used bond is just as good as a brand new one. And if it's a higher rate, it's even better. So what would happen if someone would buy the 5% bond instead of the 4% bond? Well, over the next 8 years, they'd make, if it was $100,000, that 5% bond would pay $5,000 a year. If it was $100,000, a 4% bond would pay $4,000 a year. So over the next 8 years, an investor would earn an extra $1,000 a year owning the 5% bond. So over the course of those 8 years, they would make an extra $8,000. So how much would someone pay for a 5% bond in a 4% environment? They'd pay up to an extra $8,000. Because it's like, okay, even if I pay $7,000 above the sticker price of $100,000, if I pay $107 for it, I'm still going to get back $108 plus my 5% every year. It's worth it. And then at 8%, it's a wash. At 8,000 premium, it's a wash. I'll take the 4% bond for 100,000, or the 5% bond for 108. It's a wash to me. I'll never pay 109 for it because that'd be dumb. I just take the 4%, but I for sure pay 107, right? So my point is, an investor that if rates went to 5% and they said, I'm going to go to the sidelines, their worst case scenario is that they make 5%. But there's an upside potential. If rates come back down, they can make even more than 5%, right? Let's say they bought that thing today for $100,000 and it was paying them 5%, and in 2 years they sold it for 108. Right? So they made $5,000 a year for 2 years plus an $8,000 profit on the sale. Their effective return was 9% because they made 5% a year plus they made an extra 8%, but it took them 2 years, so 4% a year. So 5 plus 4, the 9% return on this guaranteed bond. So as rates creep higher, it becomes more and more and more enticing to go to the sidelines. And that makes me a little bit nervous because what they do is they liquidate stocks to go to bonds, right? And it's downward pressure on the stock market. So the higher the interest rate goes, the less appealing the stock market looks, and the more appealing those bonds look. So I'm pretty cautious, and I would take the 5% for a portion of the portfolio. And if I could take 6, I'd probably maybe move the whole thing, So as rates go up, we're becoming more cautious. We're putting more towards that risk-free amount. And that's the threat of those interest rates. So if you ask why we're doing it or what are we thinking, that's what we're thinking. A higher interest rates makes the stock market a less attractive alternative, and we're allocating accordingly. We're trimming stocks, and as we get these opportunities to buy these bonds, we're not going out 10 years yet. But we could go out 6 months and get 5.5 and then rethink it in 6 months. So yeah, just to know where we are, we're kind of trimming stocks right now in favor of that risk-free alternative. Okay, so hope that gives you a sense of what we see in the direction we're going, and hope you guys have a great weekend or week whenever you decide to hear this. Have a good day.